Invest in the stock markets. The markets are at the best. They're booming. They've reached the high. Sensex, Nifty, small caps, mid caps. Invest. You'll make a lots of money. Market is doing great. Don't miss this chance. Invest all your money in stocks, mutual funds. Come on, let's do it. Don't invest in stock market. You lose all your money. Invest only in fixed deposits, postal savings, PPF. Stay calm and cool. Don't chase after money. You lose all your money. Stay calm, stay peaceful, stay away from the stock markets. Don't listen to both these. Both these juniors are doing wrong. One is going to lose money to the stock markets, and the other is going to lose money to inflation. I have been in this market for 3 decades, 30 years, and I have seen all the ups and downs. So neither go too extreme on stock markets, neither go nil on stock markets. It's a big mistake. Listen to me, both juniors. You both are making a mistake. When your wives don't even know what you're doing, you're losing your family's wealth. You both are doing misallocation of your assets. And today, in this video, listen to me, watch till the end. I will be teaching asset allocation, a very important topic for every family. Understood? Stay till the end. So today I'm going to do a topic that is actually or slightly complex in the nature. Complex in the way it appears and also to put it into practice. Nevertheless, this is an underrated topic, very important topic. All of us should know this. On the aspect of financial literacy that I keep talking about for families, for a young family especially. So I urge you that you know this, because this is something that you should know for the rest of your life. This topic, this concept called asset allocation. I know it sounds a little complex if you are new to the finance world, and this is something which is very important, and it's very important even as a family, even as a husband and wife, that you know it. As I've always mentioned, always emphasized, building your wealth is a teamwork. You and your wife, or you and your husband, are equal partners. So you should know and you should be accountable to each other. And this topic on asset allocation is something that every wife or every husband should hold the other responsible. Because if you make mistake in this concept, you can lose a lot of money. The problem is that no one wants to understand this concept is because those who know a lot, they want to make a lot of money. They think by the way they are investing, especially now in current times, August 2024, the markets are at all-time high in India. The BSE Sensex, the Nifty, large cap indexes, mid cap indexes, small cap indexes, they are all racing, right? They're going at a pace that is unstoppable. That is what everybody thinks. So everyone wants to invest and stay invested in equities. And I'm going to talk about this later in the video. What are the problems? So on one hand, you have those who are not bothered. They lose. And on the other hand, there are people who are too much involved and bothered. They also will lose. So how to balance these two? And this is what I'll be sharing in this video. This will be a shorter video because I don't want to get into the depth. There is a lot of data to this topic, a lot of videos on YouTube. I'll try and see how I can simplify this for my audience, for you, and I may make a few more videos on this topic because there is so much to deal with this topic. And you must learn this concept wherever you are, whichever field you are, whether you're a doctor or an engineer or a journalist or a psychologist or a speech therapist or a homemaker, whatever be your background. This concept is extremely important. This is as important as eating a nutritious diet. If your food should, or I would say, your food should be always a balanced diet. That is what we have learned when we were small. A balanced diet. And asset allocation is exactly the same. It is a balanced finance diet, which everyone should have if you want to grow your wealth, if you want to be of useful to the society, if you want to be generous, if you want to help your children to get the best education, if you want to have a good retirement. This is a very important concept. So, as always, I request you sit with your spouse. Both take notes. Because, as I said, every wife or every husband has to hold the other accountable for this concept, this way of investing. And within your financial literacy, this is one very important topic. So let's get into this important video. I hope you will stay till the end. And if you are new to to my videos, I request you to subscribe. Thank you. And let's right now get into this video, which I have titled as asset misallocation. And I don't want you to misallocate, but I want you to allocate asset allocation. So let me first start with an analogy, an example for you to understand what is this whole topic about allocation, asset allocation, right? So let's look at this example. So this is about driving, right? A car driving. So there are two people, A and B. Now A thinks cars will crash, so he or she doesn't want to drive ever. He or she thinks that if I drive a car, there will be an accident for sure. I don't want. I'd be happy walking or taking my bicycle. That's safe. I don't care when I reach. I don't care about anything. I just want to play safe. And then on the other extreme, you have B. B thinks there is no better way to drive a car than to drive at 150 kilometers per hour. Just enjoy drive. That's all driving is all about. It's fun. Right? So you have two extremes, A and B. Now, what would be your advice to A or B? Now, before we think about that advice, let me share with you what happens in the investing world. So, what are the misconceptions many have, especially in these current times when markets are rising? Indian markets, as of August 24, uh, are at their peak. All the indices, right? And there are these misconceptions which come our way, and it is so psychological. We are living in such times, so we start believing everything in a certain way. So, what is our belief? Our misconceptions or beliefs are markets won't fall or won't fall much. Invest more in small cap or mid caps. That is where the returns are because they've given 50, 60, 70% returns in the last 1 year. And in a rising market, all equity decision seems best because whatever you do, the market is going up. Now, why is this a misconception? The misconception is because markets have fallen very steeply in 2008, 2020, and many times in the history of the market. And we'll see a little more details in our subsequent sections. So markets have fallen. Now invest more in mid cap or small cap because they keep going up. They are the best, they'll give you high returns. But history tells that just like small caps and mid caps go up higher, they also fall down 20, 30%, or 40, 50%. They fall. So that is the fact, that is the truth. Now, this is a misconception because we are living in such times. And now, in a rising market, all seems equity decisions seem best, but they are not all the best because you are making decisions based on purely one factor, one element. Markets are going up. You don't look at your risk profile. You don't look at your financial goals. You don't look at what you need right now. What's your age? How many children? How much you need in retirement? You don't think all these things. You believe that this decision I made is the right decision. That is a misconception. Now, another misconception is, on the other hand, there's another misconception is that markets are very risky. You mostly lose. They only remember the 2008, 2020, or maybe 2000, when 2000, 2001, when the markets fell, markets crashed. So they only remember that. And they say, you only lose. They believe that fixed income, debt, fixed deposits, and all these may give less returns, but there's no risk of losing money. And they say, I cannot handle the volatility, so no to equities. So this is the other end. The misconception. Why the misconception? Markets are very risky, you mostly lose. That's a lie. That's false. Because in the last several decades, whether it is India or USA or other countries with developed markets, markets are volatile. They're not risky. They're volatile in the first few years for your investments. But after 5, 7 years, the risk of losing your money is zero in the stock markets. And fixed income debt may give less returns, but there's no risk of losing money. And that is also a misconception. You can lose your money. There are many banks which have closed. Even debt funds are risky because they do go up and down to an extent. And I cannot handle the volatility, so no to equities. You don't need to handle volatilities. You can check my other videos, and also you can check there are tons of material says that you don't need to handle volatility. If you invest like SIPs, or if you give it to a fund manager or a financial advisor, you don't have to go through that volatility. And there are risk profiles, which I talked in my previous video. Once you find that risk profile, your financial advisor will help you invest in the right places. So it's all a misconception. So these are the misconceptions. So now tell me, what will you tell the person, Mr. A, in that car analogy, Mr. A, who feels that, so Mr. A feels that I don't want to drive the car because cars always crash. What will you tell? You'll tell, no. See, see the roads. Come, I'll show you. How many accidents do you see? Almost nil. Accidents do happen, but they're rare and they have happened for a reason. So don't worry. Drive your car because you will reach earlier to your destination, and you'll also enjoy the ride. And cars, they're innovations, they're inventions for our good. And what do you tell the B, who believes that there is no other way to drive than to enjoy the thrill? What you have to say is that you don't have to drive 150 to enjoy the ride. Even at 80 and 100, you can still enjoy. And by driving too fast, you have a higher risk, higher probability of crashing. Then what? What's the fun? On one hand, A, you're telling drive because you will reach earlier to your destination. And B, you're telling it's driving risky is not the best way. Same in investing. There are two extremes, and we need to bring them together. Investing in equities, stock markets, mutual funds, will give you higher returns. But there is something called asset allocation. So you minimize your risk. You enjoy the thrill of driving. You reach the destination earlier. You don't lose. You don't lose your car, neither you crash. And that is asset allocation. And we will see, uncover few facts of asset allocation in this video. So asset allocation is primarily to maximize your returns and minimize your risk. Taking the example or analogy of driving your car, the whole idea of having the car is to reach your destination faster with minimum risk. And so you drive at 80 or 100, right? So again, you reach your destination fast and at the same time safely, right? We all have cars because we want to reach our destinations faster without any risk. We don't want to meet an accident. That's why we drive within the limit. We don't drive crazily. Like some of the young folks may, with that josh, they may drive very fast. But as you grow older, you know, you want the car to reach safely. And same way with your assets, same way with your investments. You want to reach towards your retirement, and even after that, you want to have wealth. You want to increase, maximize your wealth, have great returns, but at the same time, not lose your money. And that is what is the objective of asset allocation. And how is that achieved? Now, there are different methods of looking at asset allocation. So let's take a look at this chart, which gives equities, gold, fixed deposit, property. Uh, these are all the various asset classes. And in the last 5 year, 10-year, 15-year, 20-year period, 5 year, 10-year, 15-year, 20-year period, which have given the highest returns. We want to maximize returns. So which are the highest? So if you look at 5 year, it is equities. 10 years, it is again equity, 17%, and then comes property. Here, 11%, and then comes gold. 15-year period, again, if you look at it, 13.6%, and gold is 11, property is 10. And 20-year period, and this makes a lot of sense for us if we are saving for our retirement and for our children's education. 12-year, 12%, 12.9% equities, and second comes gold, 8.4. Okay, the rest of them are 5 or 6%. Now, this is no brainer. Equities give the highest returns. This is proven. There is enough data to tell us that equities are the engine for our growth of our assets. If our assets have to grow fast, it is equities. That means if you want to reach your destination fast, you need a high power engine, a good car, a high power engine, which will take you. You can't have a very slow car. You want to have a car which will take you and reach your destination. Now, why don't we buy only equities then? Why do we need gold and fixed deposit and all that? Why? And that's a very important question. And the reason is that if you look at in the last 20 years, which asset class has shown the highest volatility, right? Volatility means goes up and down, up and down. It is equities. Equities have given are highly volatile. Then comes gold, which is, if you look at it, the gold is probably a little, inversely correlated. They're not correlated. When the stocks are down, the gold went up. If you see here in 2008, when stocks went down, gold started picking up. And then here again, 2012, when the stocks are down, it went up. And same way in 2022, we do not have the 2020 data, but it clearly shows that equities were down, but gold went up, right? And also debt, as you see here, debt, they keep linearly going up. Now, again, going to the example of the car, here on one side, you need a car which will go fast, but you also need enough safety systems to keep your car less risky. To take away all that risk, you need all the safety measures built in the car. And that is what we have we need to have these different asset classes. On one hand, you've got equities that give high returns, but they're highly volatile. Over a period of time, they will give you the best returns, but they're highly volatile. But on a given period, for example, here, now if you look at this period, highest, the equities are here, gold is here, and bonds are here. So if you have a portfolio with these assets, you have high returns. Your portfolio will give you the highest returns. But when you come here, what happens? When you come here, what happens? If you only had a lot of equities, what happens? Your returns will be low. And not only returns, you will have a lot more disadvantages. And I will come to this point a little later in the presentation. But I hope you have got it. When the markets are down, your portfolio can go down because of equity. So what is the solution? The solution is asset allocation. And there are different methods of asset allocation. There are different approaches to asset allocation. And let's take a look at each of them. So one of the most common asset allocation methods is age is 100 minus age. It's by age, which means if you are 30, your equity investments should be 70%. That means you should allocate your equity investments to 70% to equity, 100 minus 30. And the rest of the 30 can be a combination of gold and bonds and anything else. So your total investments, 100% be a combination of equity and other asset classes. But because your age is 30, your equity investment should be very high, 70%. And as you grow older, 40, your equity allocation should be 60%, 50%, 60, 40%. So this is a very broadly speaking, this is one of the oldest methods of allocation which I have heard. So this is one method. The second method is by risk profile. So if you watched my last video on announcing the best mutual fund, announcing the best mutual fund. If you have seen that, there I have explained what are the risk profiles. We have got 3 risk profiles: conservative, moderate, and aggressive. Right? Conservative means you don't want to take risk at all, very little risk. Moderate means you want to take some risk, but also want to be careful. And aggressive, you want to take high risk and high returns. So there are different temperaments of people. If you have a conservative risk profile, you should have 20% to equities, not much. This is just a rough number. You should have more to debt and then rest to gold or others. Now, there could be real estate or whatever. So when your risk profile goes up moderate, maybe you can increase your equities 50%, debt 40%, and gold 10%. When you're aggressive, you will have highest equities 80% and more, and then rest to debt and gold. So this is by risk profile. The earlier one was by age, because and why age? Because you have a long runway, you can absorb that risk. And here, risk profile is you cannot absorb a lot of the risk because of your profile, because how you are, your mental makeup, your psychology, right? So that is a risk profile, by risk profile. Here, other examples are, which is another common thing, is 60-40. These are also, you have got some funds, mutual funds called balanced funds. So 60 equity, 40 debt, because obviously equities are the engine for your growth. Or else you could have 1/3 into equity, 1/3 into debt, and 1/3 into gold, because equities will give you good returns. Gold also will give you good returns, but they are less volatile. And they are not correlated to equity. So when the equities are down, your gold will go up. So it will compensate. And again, debt, which will be standard, we need some debt. Or else you have 50% equities and 50% debt. So these are some other allocation examples. There are some people who follow these. Now, what is the limitation with these asset allocation approaches or methods? One very important thing which we which we often talk about when we are talking about investing is financial goals. Now, 100 minus age ignores the entire aspect of your financial goals or your risk profile. So somebody who's 30 years old having a aggressive risk profile and another 30-year-old who's got a conservative risk profile, you cannot just take 100 minus age. For this person who's aggressive can manage 70 to 80% equities, but this person whose risk profile is conservative cannot have 70% equities. So it ignores that. So it's a good concept to begin with, but it ignores the risk profile. Now, asset allocation by risk profile again ignores the financial goals. Now, somebody who's got aggressive risk profile and they are retired, or somebody who's they're retired, can they have a huge exposure to equities? They cannot have, just because their risk profile is aggressive, right? You cannot have a lot of equities or small caps and mid caps and all very risky funds. And this person who is has a conservative risk profile but has a lot of savings to do, financial, a lot of savings to retirements, children's education, so many things. Can you have less exposure to equity? You cannot. Again, they are not complete. Whether it is 60-40, one third, or 50-50, probably they are good at a certain age. Maybe when you are 50s or 60s, probably that time you can think of all those asset allocation. When you are when you have got a lot of wealth, you want to protect your wealth. So asset allocation helps you protect your wealth. So I feel that uh, while the all the other asset allocation methods or approaches are good, but when you're starting off, when you're a young couple, your asset allocation should be based on your financial goals and your risk profile as a combination. And why do I think so? So when you have asset allocation by goals, goal based, which is called goal based also, what you're doing is you're taking into account the time horizon, which means if your retirement is 30 years, 35 years later, you you plan your asset allocation based on that, which means for your time horizon of 30, 35 years, you should look at equities. And which kind of equities? That will tell your that comes from your risk profile, which means if your risk profile is aggressive and your time horizon is next 20, 30 years, what you do is you invest into high risk equities like mid caps and small caps and flexi caps. But if you are conservative, then again you will invest into equities, but you will invest into large caps and large mid caps, less risky assets. So this is, I believe, one of the good ways of doing asset allocation when you are starting off your career, when you're starting off your marriage, when you're in your early 30s. But as you progress into your 40s and 50s, you can actually look at asset allocation holistically, because by then you've actually saved a lot of money. And then your goal is to protect your wealth. To protect your wealth, that is where you look at strategies like strategic, tactical, dynamic, and all, which we will try and talk in the next, try and talk in this presentation a little later. So what have we learned so far? We have learned that asset allocation is to maximize returns but minimize risk. And there are misconceptions about equities, risk, and other things. But you need equities because equities will help you maximize your returns. But at the same time, you need debt and gold and others to keep to reduce the volatility. And there are different ways of asset allocation approaches. You've got your age, 100 minus your age by risk profile, and maybe 60-40, one third, 50-50. And finally, we talked about how to do asset allocation, goal based asset allocation. So let's take a look at this example. Now, here is the financial goal: emergency fund, retirement, savings, etc. This is the age: 30 years, 40 years, 50 years, 60 years. Now, this is the stage when you are accumulating, you are saving. You are in your early marriagehood. You are a young couple. You would have started working few years, probably spent all your money on your wedding and other things. And now you're starting afresh. So what do you do? So first, you have to save for your emergency. And how do you do it? You start a liquid SIP. Okay. Or if you have a lump sum, save it in a mutual fund, a liquid fund, or an FD. So here is a liquid SIP. Then comes the retirement savings, right? So you are 30 years, for the next 30 years, you have to keep saving. So what do? You start with an equity SIP. So in your 30s, in your 40s, in your 50s, you keep accumulating. And then when you have reached your 60, you switch 50% of your investments to hybrid and bond, and rest 50% you can continue in your equity. So this is the way it will go on. Then your children's education, the higher studies. Start with equity SIP in your 30s, in your 40s, and when you before 50s or when you're reaching your 50s, you have to withdraw. You have to switch everything to debt. You cannot keep it till the last minute, because you cannot withdraw directly from an equity fund. What if the markets are down? So you must plan it a, a year or two before. So this is what you will do. Children's marriage, again, equity SIP, 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 and then you switch 100% to debt, right? Because that is when your children will get married. And then you're buying a home which is less than 5 years, you start an hybrid SIP, foreign vacation in the next 2 years, a debt SIP. Now, this will start forming your asset allocation. And this is very important, very, very important here. There has to be a mix. So here's the example of the goal-based asset allocation. At the assessment stage, that means you're looking at what is the percentage. So if you look at this in your 30s, when you're starting to invest, although you're investing most of your SIPs into equity, but you have a huge emergency fund, so around 80%. But then as in the next 10 years, you start accumulating a lot of equities. So equities become 80%, and the rest of them are shared by the debt and cash. But when you go 50, again, you reduce your equity exposure and you increase your debt, gold, and cash, a little bit of gold. You increase this because by this time, your children are pursuing their higher studies. You need cash. That is where you're shifting from equities into debt. And later on in your 60s, because of your retirement, your equity portion is going to 50%, and rest of it is going for the children's preparation for marriage, and also liquidity for you yourself. So that's why you've got 15% here, and cash 15%, and a little bit of gold. So let's take a look at graphically how it looks. So initially in your 30s, early 30s, you'll have a lot of cash, which is in your emergency fund, which is very important because you do not have a lot of money. And if you were to lose your job or any kind of emergency, you do not have enough cash. So this should be ideally in cash, liquid, or at the most in hybrid funds. And you're starting to accumulate in your equities and a little bit of debt because you want to buy a house and buy a car, etc., or go on a foreign vacation. Then by the next 10 years, you start accumulating a lot of equities. That's why you have this 80% equities, but then it keeps going down. And this is typically the way it should look, more or less like this, because of changing goals, reaching your financial goals, and ensuring that you maximize your returns, but you also minimize your risk. So for creating this video, I was going through a lot of articles and videos, and going back to all my studies and understanding about asset allocation. But I just wanted to find out what's happening in the world, what's happening with those people whom I know. So I just, posted a survey to a group of my friends on WhatsApp and also on my status. And I had around 25 respondents who filled this survey. And this survey was about asset allocation. How have they allocated the assets? And I just want to share with you those findings. Probably you are one of them, and you also can relate to this. And I will also share with you what are the challenges with this asset allocation, what are the advantages, what are the disadvantages, and what should be the ideal asset allocation, and where do I see issues. So let's take a look at this survey. So what are the survey findings? So the age group mostly are from the 44% is 40, between 40 and 50 years, and 36 is from 30 to 40 years, and the rest. So which means uh, 70, 80%, 44 and 36, 80% are most of the respondents. So what is their finding? So I had asked questions about, do they have financial goals, and what is their asset allocation composition. So this is the survey, and this is the chart where I have plotted all the age groups: less than 30 years, 30 to 40, 40 to 50, 50 to 60, and more than 60 years. Now, this blue lines are 100% equities, mostly equities. And then you have this red line, which is 75% equity and 25% debt. Rest of the orange lines are a mix of financial and physical assets, where high equity, and then we have the mix. The green is a mix of equity, high, debt, and gold. So you do not have the real estate. And here, the blue is a mix of financial and physical assets, where you've got high, that is maybe more of real estate or gold. Now, in this, where are the problem areas? Number one problem area here is wherever there are 100% equities. And most concerning is 40 to 50 years and 50 to 60 years having full equities. It's a blunder. You cannot have mostly equities, especially in your later years. Even here, if you have mostly into equities when you're less than 30 years, where is your emergency fund? If you, while filling, or maybe if you have not filled it, but if you, as less than 30 years, if you have mostly equities, you are in danger, because when you need money in an emergency, if you lose your job or anything else, where will you go? You will have to sell your investment. And if that time, if the markets are down, there's a crash in the market, and we have seen enough of them, you are at a loss. Your profit, your maximizing of returns and minimizing of risk, one of them is missing, one of the leg is missing. You're only maximizing returns, your focus is on maximizing returns, not on minimizing risk. Same with 30 to 40 years, and 40 to 50 years, and 50 to 60 years. I think one or two respondents, I think here it is more. Yeah, three of the respondents have actually said they're full equities. So my suggestion, my strong recommendation is, please do a reallocation. And soon, soon with in this video, I'm going to share what you need to do. So here, less than 30 years, you have a mix of financial and physical assets, high equity. I would rate this as a very good asset allocation, because at 30 years, if you have a high equity, which is good, as long as you have some debt with you, right? So there has to be some debt. Then 30 to 40 years, uh, five respondents have given 75% equity and 25% debt, which again, I would say if you are in your late 30s, this is a great asset allocation to have. In your early 30s, if you have a lot of equities, you do not have emergency fund, you could be in trouble. But otherwise, it's a great asset allocation to be. And then you have a mix of equity, debt, and gold. Debt and gold is low, high on equity. Excellent asset allocation. Um, Here you've got a mix of physical and financial assets, high equity. So these are all good. These are all good. High equity and less of physical assets, great. Now, 40 and 50 years. So this is typically where you should have a decent amount of equity, uh, 50, 50 or 60% of equities. And so this, as I said, this is a problem. So wherever you have got uh, full equities, this is a problem. This is an issue. This is an issue. So green, here you have high equity, very good. You've got a mix of financial and physical assets, high equity, good. Then you've got here a mix of financial and physical assets, high physical. So probably this is slightly problematic. You must reduce your exposure to physical assets and switch to equity assets. So you must do a reallocation. Rest, you've got one correspondent giving 75% equity, very good. And debt is high. So this yellow at 40 to 50, a high debt is not advisable. So a lot of these are fine. This is a problem. This is okay. This yellow is a problem. So yellow and blue are an issue. Here again, this blue is an issue. And this light blue, which is a mix of physical financial assets, 50 to 60 years, I would say still okay. Probably you've got high real estate and gold, but you must have at least 50% of equity. Then this above 60 years, somebody has a high equity, debt, and gold low. I would strongly recommend after 60, equity should not be high. It should be around 40% or 50%, not higher than that. So I'm sure now you're getting a grip, a understanding of this concept of asset allocation. It is very simple. You cannot, under any circumstances, you cannot have high equity, almost everything equity. It's a problem. Please rectify. Or you cannot have high debt. Now, in these examples, I did not find anybody saying high debt. Now, if you are high on debt at any stage of your life, except for those early 30s when you are accumulating, rest 40 to 50 to 50 to 60 and above 60, you can't have high debt. Probably in 60, you can have 50% debt and gold. But otherwise, you cannot have high debt. You will lose. Your portfolio will not give you high returns. It'll give you low returns. You will not be able to reach your financial goals unless you have a huge salary and you're able to use that, your disposable income before savings into all these goals to compensate. So now, what is the problem of having 100% equity portfolio? In our current markets, when it's so bullish, we have reached the peak uh, on both Nifty and Sensex, mid caps and small caps. All the indices are at the peak, are at the top. So we, as I mentioned earlier in the first slide, that we have a misconception. We start thinking that nothing can go wrong. We forget the past history. We think that this is a new thing. This is something which is new. It'll keep going up. There'll be no crash. There'll be no going down. It'll only go to 90,000, from 80,000 to 90 and a lakh. And that's what we all think about. But I'm reminded of this saying from Warren Buffett. He said, when everyone is greedy, be fearful. And right now, everyone is greedy. And 100% equity portfolio is, in a way, greed. Because you may not be greedy, you may not express or think about it. But what are you thinking? You are thinking that your money will only grow, and this is the best time to be in equities, but not 100%. Why? In any given year, a portfolio should not draw down, which means it should not, from its peak, it should not come down a lot. 30 to 40%. It can happen if the market keeps falling over a long period. And what if the markets don't recover for a few years? That will put your financial goals under strain. You may say that I am a long term investor, I'm not worried. When the markets are down, it's a great opportunity to invest. Of course, it's a great opportunity to invest. But what if you have financial goals the next year, maybe your children's higher studies, or their marriage, or your own retirement? What would you do? This happened in 2008. Markets went down by 50%. If you had invested 100, it would have become 415 in 7 years. It would have gone up. But you lose half of your wealth. That means you'll become 200 in eighth year. How do you feel? That's called the drawdown. If you had all in equity. But if you had 70% in equity, rest debt and gold, your portfolio would not have gone down so much. The 70% probably would have gone down, but your debt and gold, 30% would have gone up, especially gold, and gold went up because gold is inversely, it's not correlated. The correlation is very low, which means if it's probably negative. If equities go up, gold usually comes down, and vice versa. So if you have and the markets are falling, you can continue your SIP, but what about your goals? But on the contrary, if you have a lot of debt and your equity is falling, you can actually switch your debt to equity. That is rebalancing. Or you can continue your SIPs or increase your SIPs, and this debt or hybrid, you can use it for your goals. But if this is 0 and this is 100, and if it falls, you are in a big soup. And that's why I said in the earlier slides that 100% equity is a blunder. Please reconsider. So there is no doubt that rebalancing of a portfolio is essential, is important in time. And we must, as I explained earlier, wherever there is a need, we must rebalance. So what are the three things which I could think of under what circumstances you have to rebalance, when and how? Number one, when your percentage of equities is high, you must rebalance because, as I just mentioned, if the markets fall, your portfolio will fall and you will not have enough to probably for your financial goals, to meet your financial goals. On the other hand, if there's a high percentage of physical assets like real estate and debt or gold, again, you must rebalance because you will not gain enough returns. Your returns will not be maximized. You're, in fact, having a high real estate also, there can be risk because it doesn't, there could be any issues, especially with land registration or double registration or illiquidity that you can't sell. There are so many issues. Gold is the only one where the liquidity is high or the returns are good, but otherwise having high percentage of real estate, debt, and gold is not a good thing. Your returns will fall substantially over a 10-20 year period, and I'll share with you why do I say so. Or if you have approaching financial goals, you must rebalance, which means you have probably 80% into equities, and your children have higher studies and you need to pay their fees. Now obviously you have to pay the fees maybe in the next 1 year or 2 years. So at least when it is 1 year away, 1.5 years away, up when the financial goals are approaching, you must rebalance. You have to move from equity into hybrid and then into debt. so that when the time comes for paying the fees, you have enough cash. And if you have everything into equities or maximum into equities, and when you have a fees to pay, you may have to take it out from your emergency fund or sell off your investments at a loss. So I can think of these three things when you need to rebalance. We must have funds in at least three asset classes as a when it comes to a good portfolio allocation, asset allocation, at least three asset classes. So let's take a look at why it is important. So why should why you should have some funds in each asset class? What are the advantages? Equities. The biggest advantages of equities are over long term, they give the highest returns. In fact, equities are the engine for your growth, for the growth of your wealth. So, no doubt. And there are different categories for various risk appetites like large caps, mid caps, small caps, and they have a huge variation. So, equities themselves have so many categories. It's a great product. You must have a lot of it. Debt. They give stable returns with low volatility. You get returns 5, 6, 7, 8% returns, and it's low volatility. They don't move up and down like equities. So at any given point, if you want to withdraw, you can actually get the best of you will get the returns as expected. And it is easy liquidation without loss. So these are the advantages of debt. And so you must have debt in your portfolio. You cannot have 100% equity portfolio and not have debt. You must have debt. And third asset class I would recommend is gold. Good returns with moderate volatility compared to equity. So the returns are good, 9, 10, 11, 12% returns over a long period, but less volatility compared to equities. They're better than debt, uh, give good returns but less volatility, and they're not correlated to stocks, which means when the stocks go up they go down. When stocks fall, when there is high inflation in the environment and the stock markets fall, interest rates rise, that is when gold also rises. So they are a good asset class. Having these three asset classes is a very good portfolio. So remember, every portfolio that you have consisting of equities and debt and gold, they should give you highest returns at low risk. So you should get returns not at the cost of high risk. So this balance you must maintain. You must get high returns, but you must take care of the risk. So as we progress on this topic of asset allocation, I was thinking, it would be nice if we are aware of the do's and don'ts. Something that I have personally found it useful, which I would like to share with you. Uh, what is a quick cheat sheet on do's and don'ts? So let's begin with the don'ts. Number one, don't have all your money in one asset class. Just in this video, I previously I did share about the red flag for those having 100% into equities, which is wrong. You may get great returns, but there can come a time when the market falls or crashes or stays constant in a downturn for a long time. Then what? So never have. On the other hand, do not have all your money into fixed income or like FDs, or all your money into gold, or most of your money into real estate. That is all wrong. You must have a proper asset allocation. Second is don't focus only on financial assets or only on physical assets. So don't think that those who are investing in financial assets, don't think that, okay, real estate is bad, gold is bad. These are all physical assets. I don't want to do anything with it. Absolutely wrong. You must have at least some gold, maybe in a digital form, but that's a physical asset and it has its value. Or at the same time, don't just focus on real estate. Have lots of real estate, lots of gold. I don't believe in financial assets. So that should not be your attitude. Third, don't follow the market fads. Fads means what's trending these days. as I'm talking to you in August 2024, the trend is small caps and mid caps because they have given phenomenal returns, 50, 60, 70% returns in 1 year. And in last 5 years, probably they've given 30 to 35% compounded annualized returns. So people think that you know that is a place where I'll make a lot of money, but remember, you're a long term player. And you, if you are a young family of 30 years, 40, 50, 60, you have many more years in life stages, and there you will need other asset classes. So don't just focus on small caps, mid caps, because their fall also will be very huge. Don't have too many asset classes. See, ultimately you have to remember that you want good returns and at the same time minimizing the risk. Having asset classes like equities makes sense because it should be a must in every portfolio because it gives you the highest returns over a long period. Having debt is very useful because you have emergency fund, and also when you have your financial goals that same year, you need hard cash, you need liquid cash. So that hard cash or liquid cash can come only from a debt. Or having gold, for example, because it is negatively correlated. So when the markets are down, and if you need money along with debt, you also have gold that can be sold and converted into cash. You may have a real estate where you can get rental yields, but remember, real estate only gives 6, 7, 8% returns. So in terms of returns, it may not be great, but then having as another asset class, if you would like to, yes, it makes sense. But beyond that, I don't think it makes sense because simple, you want good returns. If you have 6, 7, 8, 10 asset classes, um, your money is spread. So where your money should be mostly into equities, it may go into other asset classes and your returns will come down. So there should be a purpose. Uh, when you can't use equities, you should be able to use another asset class. And one or two are okay, like gold or debt. Beyond that will not help because that will take away your returns. And then finally, don't ignore your financial goals. Your asset classes or your asset allocation should be closely moving with your financial goals. Don't ignore financial goals. Now let's take a quick look at do's. Do's. Do invest in at least three asset classes, as I mentioned: equities, debt, or gold. Um, there is high volatility, there is medium volatility, good returns, high volatility, very high returns, equities, medium volatility, gold, but good returns. And at the same time, you have got a low volatility, low returns. You need a mix of these. You can't just have one or two, at least three is good. When closer to the goal, equity should be rebalanced to hybrid or debt. Remember, in your asset allocation, if you have your financial goals coming very soon, you must do this. In 2008, uh, when this credit crisis happened, markets across the globe fell. Many retirees who would have retired from their work, maybe in the US, 60s or maybe 70s, they postponed their retirement simply because most of their money was into equities. When you have your goals this year, you should come out of equities 1 or 2 years prior. I would say 2 years prior to your goals, move your assets into hybrid, something like a conservative hybrid where there is more debt and a little component of equity. And then when you're closer to your goal, transfer it into debt. That is the way it should be. Third, diversify into large cap, mid cap, and small cap. So even within equities, don't just focus on high risk small caps or mid caps. Focus on large caps, equal portion in mid cap and small cap. Because the same asset allocation applies. When the markets fall, uh, the mid caps and small caps will have a much greater fall than large caps. Number four, for longer term goals like 10 to 25 years, have only in equities, because that is the only way where you can get great returns like 15, 20%. Average 12 to 15% you will get, because that is the way the companies are growing, their earnings are growing at that rate. Then finally, adjust your asset allocation by age and changing risk profile in later years. That means when you grow older, keep adjusting your asset allocation, bringing down the equities, and also depending on your risk profile, right? If your risk profile when you are young in your 30s, it is conservative, you don't want a lot of exposure to equities, but as you grow, you are able to focus and have more confidence and faith in the equity markets, your asset allocation increases. So do remember to change your asset allocation with your age and with your risk profile, because all this while I've been talking about goal based, right? So these are the do's and don'ts that you must remember. And if you have any more do's and don'ts, please let me know in the comment box. What are the other do's and don'ts that you think have helped you? So as you by now know, if you're watching my videos regularly, my mission is to help young families, right, to strengthen their relationship and also build their wealth. And at the beginning of every video, I tell you all to get your wife or get your spouse and sit together and watch. Now, did you feel in this whole video till now that you need to work as a team, husband and wife together? Probably this is a very important video where you must hold each other accountable, because a lot of times men who do a lot of investing, they're carried away by the fad, or their risk profile is very high and they don't want any asset allocation. This is the time when, if you're the if you are not the active or dominant um, um, financial manager with your husband, if you're the wife or if you're the husband who plays the second fiddle role, must ask the other person, the one who is managing the money, ask them, what is your asset allocation? Can I see what is your asset allocation? And that is very important. And probably we can ask these questions to each other uh, to know whether we are safe, whether we are in the safe ground, or where we are standing in a very risky place. So, questions as a couple you should ask to find out if your asset allocation is fine. Because remember, if your asset allocation goes for a toss, if there's an issue, you lose money. One of the primary objectives of asset allocation is to protect your wealth, because you want to maximize in returns and minimize risk. Because if you have maximum risk and minimum returns, you lose your money. So the question you can ask is, will my portfolio mix give me returns that will beat inflation? Right? If you have a lot of debt and maybe some gold or real estate, it won't beat inflation. If you have a lot of debt, fixed income, PPF, NPS, or the moderate or the conservative NPS, you will not be able to beat inflation. Number two, the question you can ask is, if interest rates go down, will my portfolio be healthy? Right? If you have a lot of debt, interest rates go down, you lose. Initially, you may gain if you are invested in the markets, the debt. But if you're into fixed deposits or other products, you stand to lose. Number three, if the markets fall, how much will it affect me? Right? If you have a huge equities portfolio, market falls, will it affect you? Will it affect your family? Will it affect your sleep? Will it affect your stress levels? Will it affect your financial goals? Will you have enough for your financial goals? So you must ask this question, will it affect me? Can 2008 or 2020 happen again? 2008, the markets fell very steeply. They fell by 50%, up to 50%. You lose half of your wealth if it was in equities. But in 2020, again, there was a huge fall. And we didn't even know what is going to happen next. What will happen? So they never announced when they happen. Are you prepared? If such a thing happens to you and your portfolio, are you prepared? And finally, what if the markets fall and don't come back for 1 or 2 years? To what extent will it affect you, right? 2021 up to 2023, the markets were flat, especially after 2022. 2021, the markets went up, then it started coming down and it was flat for a long time. What will happen to your portfolio? Will you be able to pay for your children's fees or the marriage or your financial goals by withdrawing. Because if you withdraw, markets have fallen, markets are flat, you don't gain anything. Your portfolio is not going up. It is flat or it is going down. So these are some of the questions, wives, you should ask your husband, because after all, the wealth belongs to both of you, and you both will have to go through the ups and downs. On the other hand, you cannot leave your husband and say that he is managing, so I am not worried. If anything goes wrong, he is responsible. No, you both are responsible. So take the responsibility and know about your financial health, especially when it comes to asset allocation. Will you? Please let me know in the comment box if you will. So even so, let me share quickly a little bit of my own personal allocation. How have I maintained it? It's not the perfect way or the way I have described, but in many ways it mirrors what I've been talking about. It reflects my own philosophy, and I will also explain why. So I have consciously tried to maintain the asset allocation, and what has driven me to do this is my financial goals, the goal based asset allocation. I have not strictly gone by the age, but more with my the life stages. For example, I've got two children, their education. My my elder daughter is in the third year degree, and my younger daughter is in the 12th grade. So I have set aside funds for them in the hybrid and debt. A very little portion of that could be into equities, which, when time permits, I will move it, or I will use my current income to fund that. But primarily, a lot, it's in hybrid and debt. So anything happens to the stock markets, I'm not really worried, because because the children's education money is not in fully into equity, a very little portion. Even if my income stops temporarily, by God's grace, thank God that He's the one who provides, I believe, and He's given me the wisdom to ensure that we have emergency funds. And also, most of my, in fact, all my retirement money and how I will use my retirement money is all into equities. So I'm not touching that. On the contrary, I'm building it, and the next slide I'll show you the percentage. And even for children's marriage, so obviously that will be probably another 7, 8, 10 years. Both my daughters put together, God willing. Most of that is into equities and hybrid. Now, just a quick look at my own asset allocation. 60% of it is into equity. In fact, it was 50% a couple of years back, but the markets have gone up. And because of that, the equities have become 60%. Now, if the markets go down, it may come down a little bit. So I'm not really planning to do any rebalancing right now. Debt is 18%, and hybrid, as I mentioned, this 10% and 18% is something that can be used for my children's education. And this cash is for our daily consumption. Whenever our income dips down, this is the money that will be used for our day-to-day expenses. So this is pretty much the asset allocation that I have. This is close to what I talked to you in my previous slides, which I'll quickly share with you here. So this is what I shared in the 50s. I'm in my 50s, early 50s, and here I had recommended a 60% equity, 20% debt. I have roughly 18%, and 10% gold, but I have it in hybrid. Uh, I'm sure you're wondering, I've been talking about gold, why I do not have any allocation to gold. There were some reasons in the past because of which I never had. I may add to this, you know, move from hybrid into gold a little bit, especially gold ETFs or physical gold, not the jewelry. Although we are okay to, dispose of our jewelry to some extent if you want cash. But right now, that is not the plan. And the house that we live in is our real estate. So I've not added it here. But if need arises, I'm okay to move to a smaller house from the current house. And we still believe, we still feel that yes, it's okay to you know sell that asset to generate cash. But since we are living in that, I do not want to add it in the current asset allocation. So this is my current asset allocation. Do let me know in the comment box, what is your current asset allocation? Are you somewhere close to this? And I can tell you from my own experience, uh, in my 30s, I had a lot more equity than cash. My emergency fund was not so well. In my 40s, a lot of my money went into the house, purchasing of the house, EMIs and all. Equities was very less comparatively. It was more into debt, obviously, because of the PF and other investments. So I had more into debt and less into equity. And I believe strongly that this, if I had maintained this, then my wealth projection could have been different. My wealth would have grown very differently. Right now, I have a lot of asset allocation, but I should have had more asset allocation in terms of equities in my 40s, which I did not have. So between 30s, the late 30s, and late 40s, this is a period where even career-wise, a lot of us do well. Salary increases. This is where you should allocate most of your money into equities, because that will help you grow your wealth. Your wealth will grow exponentially. And I would say that I missed that period of my life. So you do not miss. Be a good steward, a good manager, a good servant of the money that God has given you, and save, invest in the right places. And this asset allocation will really help you maximize your returns and minimize your risks. Don't get carried away at this young age. Will you? Will you follow this asset allocation? Do let me know. Share your comments. So this is the last section which I want to share with you in terms of what is the impact of a good asset allocation over the years from age 30 to 40 to 50 to 60 when you are retiring. So this has a few numbers. Uh, I don't want you to get lost in the numbers, but I want you to understand the concept and the final impact of a good portfolio. So this is a high equity asset allocation projection. So here is a person who has net worth 50 lakhs at 40, and then investable money is 50,000, which he or she distributes according to this percentage at 40, 80, 10, 10. So this is what this person starts investing at 40, doing an SIP in equity, debt, and cash. Just to keep it simple, I'm showing as though this person is doing an SIP. Debt is for financial goals, which are close to which are financial goals which are very close to your age, and also cash, which is you're building uh, you have an emergency fund, but you're building your emergency fund to suit your current age. And here at 50, you get a salary hike, that is 10 years later, almost 5 to 6% per annum hike. You have a lakh which you distribute according to this percentage. So what happens? By the time you are 60, here is the projection. When you're 40, this is where is your net worth. Then at 50, because of your regular investing, the equities have become 2 crore 50 lakhs, and your total is 2.81. And you continue to do your SIPs from 50 to 60, and your equity has grown to around 11 crore, and debt 70 lakhs, gold 20 lakhs, cash 36 lakhs. So you have 11.96 crores. as your uh, net worth after at 60. And obviously, here the percentage is high. You will have to rebalance the portfolio, which we've already talked about. Now, this is how it shows. Initially, they are all very close to each other, but then it keeps going up. Exponential returns, right? From 50 to 60, exponential returns, while the rest of them have a very small percentage, which you can then allocate it, rebalance it. Now, this is high equity projections. Let's take a look at the high debt projections. Now, this is a high debt asset allocation. Everything remains the same except for the equity percentage is low, 30, 50, and 50, and the debt percentage is high, especially in your 40s and 50s, right? Later on, you increase your allocation to equities because probably your risk profile changes or you need to save for your retirement. And this is the way it looks. Your final total is 8.5 crore. And here, if you see, they're all together, but later on, you have an exponential returns. But this is distributed between all the asset classes. Now, what is the difference? The difference is a high equity versus a high debt. If you look at equity, it is almost 12 crores, and here it is 8.5 crores because of your asset allocation. And this asset allocation is not so risky. It's not everything in equity, if you notice. There is debt, there is gold, there is cash, a lot of a big percentage. And here also you have a very big percentage, but this person was willing to take a risk, not too high risk, but a moderate risk, also have enough debt, hybrid gold. And this person was not willing to. So you see the difference. Now, there are a lot of portfolios which are much less. So they may even get 4 to 5 crores only, but see the difference. So if you want to retire with a good corpus, at the same time, don't want to take a high risk, you must allocate your assets accordingly, especially have high equities. Good equities, a good percentage of equities will help you grow your wealth. I hope you've got the gist here. This is just a sample. In reality, it exactly doesn't happen like this, but more or less like this, because in reality, you also have a lot of financial goals for which you have to spend money. You have to withdraw your investment. So a whole lot of things happen. But this is just a gist of how things will work out for you. So as always, let's do a quick summary of what we have done so far. I love doing this summary so that you will remember everything what we have done. We started first with the misconceptions, where you have only equity or only debt. You remember the analogy of the car. Somebody doesn't want to buy a car because he or she believes they can crash. And on the other hand, there is someone who wants to just enjoy the ride and drive fast. But both are wrong. You must have a car which will take you from one place to the other quickly, at the same time have low risk. Then we talked about equities gives highest returns compared to other asset classes. Over the last 20, 30 years, equities have given highest returns, but they also are very volatile, highly volatile. They don't go in a straight linear fashion. They are volatile. They go down, up, down, but overall, eventually they go up. So to ensure that you do not get caught in on the wrong side, on the wrong end, especially when the markets are down, you allocate your asset allocations. There are several approaches we talked about. There are approaches where you've got 100 minus your age. Then you have other asset allocation strategies like 70, 30, 60, 40, 50, 50, or a risk profile based. If you're a conservative risk profile, have less equities. Aggressive risk profile, you've got high equities. But then we also talked about the goal based asset allocation, which is quite practical, which we all have to adopt. And I also talked about the survey findings and how there are red flags, especially where there are 100% equities, and there are challenges with 100% equity portfolios. So there is a need for balancing asset class. And I've also talked about when and how you should do, especially as you grow in age. But more important is when you are reaching your financial goals. Then we talked about the importance of all the different asset classes like equity, debt, and gold. I also talked about my own personal asset allocation. We talked about the do's and don'ts, what you should do and what you should not do, and the questions couples should ask about their portfolio. So please remember, wives especially, ask your husband, what is the asset allocation portfolio? Show me the percentage, and probably compare it with whatever I shared, or watch other videos which will tell you what is the right asset allocation, especially goal based. And finally, we talked about high equity and high debt asset allocation projections, a comparison of two asset allocation, high equity and high debt. So we've come to the end. Uh, I wonder how much you have understood this whole concept of asset allocation. Did you really like it? Did it add value to you? Will it help you in your wealth building exercise, in your wealth building journey? I would love to know your comments. Please take a few minutes and write down, what do you think? You can even be critical and tell me what is missing, and I will try to improve my videos as and when I post new videos. And if you've liked this, please share a thumbs up to know whether you've liked it. And if you are new to this channel, please subscribe to my channel, so that you will be one of those who know about my videos right at the beginning when I post them. I want to post as often as I can, and as I've always mentioned, my goal is to help young families. My mission is to help young families grow their wealth and their relationship, their marriage together, because both are important, especially as you grow in your years. You want to enjoy a relationship also. You want to have a great family, right? Money is not everything, but at the same time, money is so important. So thank you for watching this video till the end. I will see you very soon.